Well, welcome back to another session of Insanity. That's right, with me, your host, Joe Messina. Always a pleasure to have you with me. Let's get right back at it because, I always love when David's on with us. I don't get enough of his time. And this time we're not really beating up on the stock market. We're not beating up on what's going on in the market. He's kind of trying to help you understand how money flows, how your money flows, even if you don't have a whole bunch of it. It's okay. You still got something to work with. You know what I'm saying? Okay. David Fischer, CEO of Landmark Capital. And David, we're going through what has turned out to be a three-part series. And I've asked David to really just, instead of talking about the business of the day, if you would, talk about how money moves. You need to get a basic understanding of how money moves through the system and how you can protect your dollars and how you can make sure your family's safe in the what may be the upcoming recession that David talked about earlier. But, David, first of all, thanks for being with me a second. Thanks for breaking it down in a way that I would say most of us can understand. Most of us can get a grasp, if you would, right?
Well, it's important that everybody understands it's, if you didn't understand the basics of driving a car, you're going to have a car wreck.
That's true.
If you didn't understand the basics of your occupation, you're not going to do well in your career. And if you don't understand the basics of how markets move in a cycle, and understand where we are in this economic cycle and what drives it or stops it, then you're just going to be tossed and turned by whatever happens to you. So life, people that have a plan usually don't fail in the plan because they have a plan. But let's take a look at what recession really is. And Webster says it's a period of temporary economic decline during which trade and industrial activity is reduced, generally identified by the fall of the GDP, gross domestic product, that's what GDP means, in 2 successive quarters. So in other words, when a country, United States, let's say, the GDP falls for 2 consecutive quarters, that's simply put 6 months, okay? When that happens, we're in a recession. So we haven't had 2 consecutive quarters of fall for a long time. Right. And typically recessions happen every 7 or 8 years. The last one we had, 2007. So we've gone 11 years since a recession. So we're well beyond the norm of what a recession is. That's why, as they say, we're ahead of ourselves. We're having some things happening here that triggers a recession. And the number one thing that has triggered a recession before, well, I don't want to say the number one thing. Let me say it this way. 9 times out of 10, this has caused a recession. When the Federal Reserve starts to do something that changes the environment, whatever that is, and we see longer-term rates become lower than shorter-term rates. In other words, the 10-year yield of a Treasury bill becomes lower than a 2-year yield of the Treasury bill. That's starting to happen. Let's put it into perspective here now. Well, the 10-year is at 2.86% in its yield, and the 2-year, I think, is about 2.3. It's gotten closer together within a quarter of a basis point. So it's moved closer by 30% this year, which is a big change, getting closer. When this thing calls inverts, in other words, when the shorter term rates become higher than a longer term rate, that causes a recession 9 times out of 10. And that's what economists, not gold guys, economists are saying this is where we're going. Because the Fed, what's causing that, the short term rates are going up. The Fed is raising the rates. They're going to raise it for the next couple of years. And we're seeing the longer term rate, the 10-year, not raising. It's actually coming down. Which says, the belief says, I don't want to hold this money for 10 years because in 10 years I think there's going to be a financial turmoil. So the money is telling us, the market is saying, this is going to turn into a problem within the next couple of years when the Fed continues to raise rates, and the Fed spoke today, or spoke recently, and been speaking, saying they're going to continue with this rate hike. There's now a 60% chance of a December rate hike, according to the Fed. They just announced this here recently. And it was just a couple months ago 34% chance. So the chances of raising rates are getting more stronger, not weaker. So this is going to trigger more than likely a recession. But this time around, I'm not a doomsdayer, everybody knows that, Joe. This time around, there's people out there who have nothing to do with gold are saying this is going to be the biggest recession they've ever had in their lifetime, like Jim Rogers, the guy who wears the funny bow ties. He's a billionaire. He loves America. Doesn't know a gold company, doesn't tell you to put all your money in the gold or anything like that. He's not a chicken little sky is falling, and I'm not either. But he's saying this is going to be the biggest problem we've ever faced because the world is in the biggest debt structure we've ever faced, which has been led by the American.
So not to interrupt you, but it's not because of anything that Trump is doing. It's not because of anything. It's that the world as a whole, the world economy, is in so much debt, is in a borrowing spiral.
Like I'm going to quote Trump, this should have been taken care of a long time ago. We should have fixed our national debt, $20 trillion, a long time ago. We should have taken our reliance upon treasuries subsidizing or overspending a long time ago. We should have not propagated our citizens going into debt a long time ago, but it's not happened that way. And so this is part of the Federal Reserve problem. This is part of the media problem. This is part of the way the financial industry unfortunately works, because debt has also made America great, but debt is also the thing that will ensnarl us and hold us captive. They're deeper and longer than we ever want to be held, and that's coming up. It has nothing to do with Trump, except for this. President Trump is on a spending mode, faster than any president in history, yes, faster than Obama at the rate he's going. And the deficit for the government is ballooning faster than it's ballooned in a long time. But he's doing it for a purpose, trying to stimulate the economy, to create tax revenue, to create job growth, to create a healthy America and making America great. Unfortunately, like I said before, it's never worked, not even under Reagan. My dad served with Reagan. So it's really the only thing that they can do on the what you call the supply side. They need to also start the other side of backing down from the overspending, and so far that's not happened. It's just been the opposite, and he campaigned upon that. So there's an element that Trump is causing more problems with this, but the problem was significantly there already, and he's choosing this path to fix it.
Yeah, and again, people need to understand exactly what he said. It's really funny that these economic experts for years, I don't know, David, you know better than I do, obviously. Why haven't they been screaming from the rooftops? And every economic advisor that comes up under a president, why haven't they been screaming to stop this kind of spending?
Well, human behavior says, I'll take care of it when it's a problem. It's not become a problem yet. I mean, why didn't we take care of Lehman Brothers and Bear Stearns? Why didn't the government intercede in those two companies? Well, because we have free markets, so it's not a problem of the government, number one. Why didn't they fix Fannie Mae and Freddie Mac? Well, they're independent and they were taken over by the government. But, why didn't the banking industry fix that? They said, it wasn't a problem then. But it only took one major domino cause another domino to fall, and that's what caused the recession in 2007. So we're not in a crisis right now. We're in an uncertainty of the market, which is different from a financial crisis. We were in a financial crisis of 2007 that was triggered by debt, and we never took care of that debt. Like I said, President Trump has said this should have been taken care of a long time ago. He's trying to take care of it in his plan, but unfortunately, the thing is growing $21 trillion of debt is much bigger than 14. Let's think about that for a simple way of putting it, and that's what it was when we had a problem before. And there's more leveraging of money. There's 700 or so trillion dollars of derivative risk that happened, 680 in 2007, which brought the system down. Now there's 1.5 quadrillion or 1,500 trillion. The numbers are just staggering. We're two times more debt structure in what caused this problem now happening, and the debt of the world is bigger. There's all this money that's been created by the Fed and the European Monetary Union and the Bank of Japan. We're talking about $40 trillion that has been created in this last decade that they got to deal with. And so this is all going to come down when rates get higher. And the euro is going to raise rates starting December of 2019. So they're following the same footpath of the Fed. This is a global problem that's going to be fixed. They got the genie out of the bottle or the baby out of the womb. They can't put it back in.
Wow. Just wow.
So that's why I say get your debt under control. How do you prepare? It's really important. And investing is only thinking into the future.
All right.
Investing that's how simple that is.
Yeah, you got to hold that thought. Some people need to go throw up right now. And but anyway, we got to go for break. We'll be back in a minute. I'm Joe Messina, your host. Always a pleasure. Don't go far. David Fischer will still be with us on the other side. We are back. I'm Joe Messina, your host. Always a pleasure to have you with me. 855-REAL-JOE. 855-732-5563. Thank you for being with us. Thank you for being with me. Thank you for taking some time to get involved and engaged. But you know what? Mostly, I want you to understand how to deal with your money. You know why? So that you can send me more of it. Not the government, me. All right, we're back at it. This is, I guess it's part 3. I've asked David Fischer, CEO of Landmark Capital, to join and talk about finances at a basic level, how money moves, how it affects us, what we need to be watching for. Because I really want you guys to understand. I want you to know and see how your money moves and what you need to do to protect it. Because ultimately, seriously, let's think about this. You are not experts in money. I'm not an expert in money. You know, I know some of you do fix your own car, but a lot of you don't have experts in air conditioning to fix your air conditioning unit, or your electricians or plumbers. You go to the experts. You need to do the same thing with your finances. We need to go to the experts to find out what it is we need to do. And that's why David Fischer is a trusted entity on the show. I trust David. My family's done business with David. He's not just a sponsor, but I'm one of his clients. So, and I haven't heard from anybody. If you've done business with David, I'd love to hear from you as to what your experience was like. So, David Fischer is joining us. No, he's here with us now. David, thanks for being with me, and I do appreciate the time that you've taken to do this, because this is not selling for you. This is actually helping people. You're teaching a class here. I think we should charge like $300 an episode, but that's just my personal opinion. Because you don't get this in school anymore. Economics 101 isn't really taught in school anymore like it used to be in the 70s when I was going to school.
They didn't even teach us how to balance a checkbook. My dad had taught me that one. So, unfortunately, the head of Ford said, if everybody knew today was instructed on how the Federal Reserve actually works, there would be a revolt in the morning. So, I mean, it's, and that was, Henry Ford said that when he was alive. So, and I'm paraphrasing, I can get the exact quote. I said it on session part 2, I think it was. But, I'm not against the Fed, and I'm not against our government, but against when they overstep their boundaries and they start to impact free markets and they do things that what they're not created to do. And I'm against debt structures, because debt has always been the thing that has caused problems in every economy, in every family, every situation, every corporation. It leads us down a road that you don't want to go. I mean, it's okay to have manageable debt, but we're not in an environment where this is a manageable thing right now. We should be paying down our debt, not going into debt in the latter part of this market cycle. So what magnifies this, before we get into the fix here, is the Fed is doing something that in my lifetime, I'm 56, it's never done before at the level. It's unwinding the balance sheet, and I talked previously about that, but this is a big key. The Fed has bought our currency called treasuries. They're the biggest holder of treasuries. China used to be, but the Fed has taken the number 1 slot, and now they're going to be the biggest, and they are the biggest seller of our treasuries. They hold $4.5 trillion in treasuries and a thing called mortgage-backed securities, which they use as assets to make money to inject in the system through quantitative easing 1, 2, and 3. And now they have to pull, as they say, pull away the punch bowl, unravel the balance sheet, let the markets stand on their own. And that's why we're having some problems this year. The market's not performing this year. Why? Because the Fed is upping the amount that they're selling right now. Every quarter they up it. When we get to the fourth quarter, they're going to be at full capacity of selling $50 billion a month. Next year, they're going to do $600 billion. They got to get rid of somewhere around $3.5 trillion. So it's going to take a couple years. While they're doing this, they're raising rates, which will create this whole inversion where higher rates are lower than lower rates. Inverted yield curve is the term. That creates recession. So we're seeing all this happen. That's why they can't get rid of the balance sheet fast enough. But they don't want to do it too fast to cause market gyration or market volatility. Wow. So they're trying to find the balance, and that's why you're going to have hiccups. That's why it's going to become an issue a year or so from now when rates are higher. And this is the plan that they are committed to doing because they have to get their balance sheet down to be lean and mean because they see the problem coming. So that's why you should take David out of the picture. The Fed sees this coming. Other central banks see this coming. Billionaires, 25 of them this year, I spoke at a conference saying this is coming. There's a conference going on, another one this year. As I speak, they're saying it's coming. So there's a handful that are saying it's not coming. That's okay. Everybody's entitled to their opinion. As my dad said, that's what makes the world go round. But we've learned from 2008 to say, let's not ignore the problem. It was a problem then, but most people said it's not going to be a problem. Now they're starting to put a little bit of warning signs out there. The biggest investors out there are saying, we have seen some signs, not in the near future, but it will come, a recession probably a year to year and a half from now, if not by 2020. So it's coming, and preparation is the key.
You know, again, I want to get back to over the last couple of years, you're not one that always screams the sky is falling, we're done for, hide under your bed, and all that. You've never actually, it's really funny because I tell people all the time, the precious metal guy doesn't push, 24/7 precious metals. You always talk about the different diversities you need to have, and you need to be invested in different things. Why don't you, we've got about 4 minutes left, and I know it's, like I said, it's not a sales thing, but in basic economics 101, where should people be putting their money? What should they be looking for so that they can weather the storm, that our storm when it hits?
Well, first of all, Joe, I've never put precious metal first. Say take care of your debt is the first and most important thing, because what good does it do if precious metals are always just 10, 20%, but you're paying a 24% on your credit card? That makes no economic sense. It's just sheer simple math.
But so, I got my TV early. I've been able to enjoy it for the last 2 years. All right.
Your TV, the sticker price was $3,000 is costing you $4,500 by putting on a credit card. So, I mean, that's what the problem is. We have a I want it now society, and now we're paying for it. The government is I want it now. But so get your debt under control, because as rates goes up, it's only going to make it more challenging. And as we move into recession and you have a debt structure, it's hard to make those bills. So, I mean, you think it's hard now. It's going to be harder as rates goes up and we move closer to the recession, because people hold on to their money during those times, which makes less revenue for the economy. So get your debt under control. What am I saying? Get those credit cards paid down to zero. That's the first and foremost. Mm-hmm. So do that. Most people live in a home. They got to pay for a mortgage. I'm not telling you to sell your house and don't have a mortgage. Okay, I think that's important. You still get a tax write-off. Yeah. If you have money beyond getting your debt under control, then get some money in the bank. Don't put it in the coffee can in the backyard like Joe. Sorry, Joe, to throw you under the bus. I don't have any coffee cans in my backyard, so don't come looking for me.
I got plastic ones just so they wouldn't rot.
I don't have any money in my backyard, okay? I got a nice backyard, but there's no money in it. Yeah. So anyway, get some money in a savings account, 3 to 6 months, in case we have a major recession. It saved a lot of people grief last time.
Yep.
Now, diversify. Get some money in stocks, and be very careful about that, because you're buying at an all-time high market that's showing some challenges. But there are ways of making money in stocks right now. And get some metals. And I get it, gold's not going up, but investing is not done for the now, it's done for the future. And you got to determine if you're a buy and hold person or if you're a trader. If you're a trader, gold is not for you. And it may sound contradicting myself. This is a buy and hold when you get metals. Stocks really should be a buy and hold, but we're not quite in that environment because there's different ways of investing in stocks, and I'm not a financial planner, but I've invested in stocks a lot over the years. We're in a different environment in stocks right now. Got to be really choosy. Get some research done. There's places you can go. You can, and I'm not endorsing these companies, although I'm a spokesperson for TD Ameritrade. I'm a contributor, not a spokesperson. Clarify that. I'm a contributor. They call me and they want to interview me about what's going on in the economic environment. We talked a little bit about metals too. So you can go to there, sign up with them, get an account with them. I used to have a Scottrade account. TD Ameritrade recently bought them out. But you get some education from the people who are in the know in those areas, and learn. Just like you would learn about precious metals, just like you learn about this plan. Put some money in these different areas. That was what will save you some grief down the road.
Well, I agree with you. And this is why guys like you hang out, or I hang out with guys like you because you're so knowledgeable. And it's not a pressure thing. That's what people need to understand. But hey, you got to get David's new newsletter that's out. It's titled "Tariffs: The Untold Story, Part 1," which means there's a Part 2, so you have to pay attention. The newsletter talks about David's 8 previous predictions that came to pass. Also, David gives 2 future in-depth predictions. Now, you can't do that just sitting on your couch. You have to do one of 2 things. Head over to landmarkgold.com and check it out there, or call 844-715-7311, 844-715-7311. David, really appreciate the time you've taken in explaining all of this to the listeners. Really do. And what I probably will eventually do is put the whole series up in one big podcast so people can actually grab it, pull it down. And we got so much more of this coming up soon. I'm Joe Messina, your host. Don't go far. A lot more coming up in the next hour. Sessions, Rosenstein, and Mueller all have one thing in common, is that they need to go. That's really what it boils down to. I'm Joe Messina, your host.